AstraZeneca has a lot of investors interested because of the various factors going around right now. Notably, AstraZeneca's business is under investigation in China, and that's a big headwind that caused the share price to fall. On the other hand, AstraZeneca is developing weight loss drugs in a market that's booming with consumer demand soaring for these remedies. So it's understandable that investors are interested in AstraZeneca stock. But what's a fair price to buy this business? That's what I'll answer in this video by doing a discounted cash flow valuation on AstraZeneca so we can see what's a fair price to buy this stock. Let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So the discounted cash flow valuation model has three sections: the section on cash flows, the section on the discount rate, and the section breaking it down into the value per share. If you don't want to wait until the end of the video, the base case scenario, the intrinsic value per share is $539. And I also ran two other scenarios where the intrinsic value per share is $189 and $89 per share. So the intrinsic value, the fair price calculation is wide. The range is wider than usual. There's an interesting factor about that. So if you stick around, you see the whole breakdown, you'll get a better explanation of why the intrinsic value is where it is according to my calculations. Let's start with the free cash flow forecast. According to Wall Street analysts, they think AstraZeneca's free cash flows are going to rise from $9.94 billion in 2024 all the way up to $18.8 billion in 2029. From that point on, I did my own forecast, and I believe the company's free cash flow will rise from $18.8 billion to $25.18 billion in 2034. The free cash flows from 2035 onward, instead of doing them individually, I utilized the terminal value shortcut. That takes the free cash flow 1 year ahead, divided by the weighted average cost of capital minus the growth rate. So in this case, the terminal value is $2.8 trillion for AstraZeneca. That's a high terminal value for a business and signifies the strong cash flows expected for AstraZeneca over its lifetime. The present value of its future cash flows is $1.7 trillion. So this business, according to Wall Street and according to my forecasts, is expected to earn a great deal of free cash flow between now and the very, very long term. The discount rate that I used for AstraZeneca is extremely low at 5.94%. Now, because it's so low, I've doubted this calculation. I've doubted the accuracy of this calculation. And so I did two additional scenarios with a higher cost of capital that I'll talk about after I complete this scenario. So I've given them a cost of debt of 8%, and the cost of equity at 5.58% is extremely low because the business has a beta of 0.18. Now, I find that to be unrealistic, a cost of equity of just 5.58%, because right now you can get a 20-year government bond that yields over 5%. So why would you invest in a stock that's a lot riskier than a government bond if you're only going to expect an extra 30 basis points or 40 basis points in return above the risk-free rate? So that's why I adjusted this beta. Right now, its historical beta is 0.18. Risk-free rate is 4.5%, and the market risk premium is 6%. Its market cap is $223 billion, and it has $30 billion in debt. And so I've given them a target capital structure of 15% debt and 85% equity. So now we can go to the value of operations, add the company's cash balance and subtract the debt, and we get the value of equity of $1.683 trillion. We want to know the price per share, so we divide by the number of shares outstanding, which is 3.124 billion, and we get a price per share of $539. That compares favorably to the current market price of $75. But that's likely due to the very low cost of equity that AstraZeneca boasts right now. as a result of the very low beta of 0.18. As a reminder, the average stock has a beta of 1. A beta of 1 means that a stock is not more risky or less risky than the S&P 500 index. It has equal risk. So anything below 1 is a lower risk business. And AstraZeneca at 0.18 is the lowest out of any business I've evaluated. Generally, healthcare stocks have a much lower beta, and that's because healthcare companies are not strongly correlated to the economy. If the economy is booming or if the economy is in recession, that hardly impacts a business like AstraZeneca or other healthcare companies in their revenues and profitability. People need healthcare when they get sick, not when they get a new job or not when there's a recession. Healthcare is not correlated to economic growth like other businesses are in the way of, like, let's say Macy's is very correlated because if you get a better job, you're more likely to go to Macy's to get better clothes, right? Those are connected and correlated. Healthcare, not so much. So that's why healthcare companies have low betas like AstraZeneca. But I adjusted the beta higher in a couple of scenarios. I looked at it if the beta was 0.5 instead of 0.18, the intrinsic value would be $189. And if I raised the beta all the way up to 1, which would not count AstraZeneca as a lower risk business, it would count it as an average risk business, the intrinsic value per share would be $89.73. And even in that scenario, it would be higher than the current market price of $75. So, given the fact that I evaluated this company on 3 different scenarios, and all 3 scenarios signified or showcased that the intrinsic value is higher than the market price, with a safe margin of safety of 10%, I can go ahead and come to the conclusion that AstraZeneca stock is indeed undervalued according to my calculations using these estimates. So just for transparency's sake, the numbers highlighted in blue I got from Yahoo Finance, and the numbers shaded in green here I got from ticker.com, the Wall Street analysts' numbers from ticker.com. As always, you should do your own due diligence before making a decision on any of these stocks. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.